estimates do not equal expectations.
And so it feels like taking a wild bet to enter a position right before earnings.
Stocks I expect to go up went down. Stocks I expected to go down went up. But it doesn't hurt as much if you're following a defense first strategy.
You are listening to Right of the Chart, the podcast for self-guided independent traders. Hey everybody, thanks for joining the podcast today. I am Sean Vincent. I am the voice of Right of the Chart. Adam Sarhan is the brains behind Right of the Chart. Adam Sarhan is the creator of the A.M.P.D trading strategy. That's A.M.P.D. It's a strategy for self-guided independent traders designed to help them keep their losses small and let their winners fly. Today I'm talking to John Frost. He's a friend of mine. He is a student of Adam's A.M.P.D trading strategy. Like me, he runs a model portfolio designed to showcase how the A.M.P.D trading strategy works. It's been a volatile earnings season, and we've learned some lessons about how we manage our protective stops as we move through earnings seasons, and thoughts about getting into positions before and after earnings announcements. Here's my conversation with John Frost.
But before we get to all of that, remember that in the market, the past does not predict the future. No results are typical, and there is inherent risk when trading in the market. This podcast is for educational purposes and does not constitute financial advice.
How have you liked the earnings season so far as the manager of a model portfolio?
Volatile is the word to describe it for me. So too exciting for my taste.
Too exciting for my tastes. Yeah.
Stocks I expect to go up went down. Stocks I expected to go down went up because the behavior of the market is different from the behavior of the estimates.
Yeah, okay. And that's really a lot of what drives price, right? It's funny, we talk about, and I think people who trade stocks regularly understand this, but still there's a fundamental mindset that the price of a stock is somehow connected to the health of a company. And like meme stocks like GameStop demonstrate in an extreme way that that's not necessarily always the case, right?
Right. And also institutional expectations, which are cloudy and unknown, can change the direction of a stock without
That's right. And so
any insight.
a stock for a company that is doing reasonably well and is healthy, but somehow an earnings report is different than what was expected, then that can drive people to make funny choices in the market. And then the price moves fast. It moves a lot in a single day sometimes.
Yeah. What I wrote in my journal yesterday was that estimates do not equal expectations. So just beating the estimates does not mean that the stock is going to beat the expectations of whatever institutional investors out there are looking at it.
Right. And so we've been through other earnings seasons that haven't had this type of volatility. There's something in the air. Do you have any theories on that?
Yeah, I do. My theory is a lot of this is hanging on the big tech stocks right now and the direction of how they're going, because that's what's been driving the market. Nasdaq, S&P 500, QQQ for so long, and there's now a feeling like those stocks have to really knock it out of the park for their to make sure that their price is worth it, right?
Right.
So the expectations are much higher than they were 6 months ago, and quadruple than what they were a year ago for those tech stocks.
Sure. Have you seen your portfolio become less tech heavy over the last couple months?
No, actually.
Really?
but that resulted in me being burned last night. So
Oh, okay, yeah.
maybe I should have. What I actually got out of was biotech stocks because I expected the biotech industry, based off of some things that Adam said in his report, the biotech stocks might be more volatile than I was willing to invest in at the time. So I switched back to tech, which seemed like more of a steady thing.
And it's not been as steady as we as we've come to expect it to be over the last year. Um, so let's talk about this. So we're speaking to self-guided independent traders who are interested in the A.M.P.D trading strategy, and with A.M.P.D, a key way that we manage risk is with our protective stops, right? And so
Correct.
for the sake of the audience, the idea is that when you enter in a position, uh, we like to kind of enter in a position at 10% of the value of the portfolio, and then you place a protective stop at 5 to 7% below your entry point, which means if you did that with 10% of your portfolio, then you're putting basically somewhere between 0.5% and 0.7% at risk, uh, hoping that unless you have big gap downs like I experienced a couple of times this week, and then you might risk a little bit more than you meant to if that stop doesn't hold, right? Um, but what that means is that when you enter, so the idea is, and now you have that stop in place, and if you have a good one that is increasing in value, then you can pretty quickly, hopefully, raise your stop to break even, and then raise your stop more to lock in profits. The trick is, though, that you don't want to lock it in so tight that you don't give the stock room to breathe. You know, that you can handle a little bit of volatility. And when you have an earnings season like this, where lots of stocks are moving up and down after earnings, then you can get stopped out of winners in some cases, and in other cases, you're super glad that stop was there because the stock just kept going down.
Yeah, I think it's hard to know what the difference is. A lot of the stops I stocked out of yesterday and this morning were ones that just had one really downward spike, and that stopped me out, and then it went back up and is either at a small loss or showing profit again today. Um, in my experience, what I've keeping the stops tight kept my losses small, and so I may have stopped out on 4 stocks for 3% or less of each of those positions,
Right.
but this I'd made so much more money earlier this cycle by letting my winners fly that I'm still up overall for the quarter. So you just have to keep that larger goal in mind. And it
Yeah.
hurts, but it doesn't hurt as much if you're following a defense first strategy.
Yeah. The one that gets me this earnings season was Goosehead Insurance. And I got into that one because it had a nice flag off of uh, Big Up Day, right? And I was having some luck with Affleck that was holding up, and it was a non-tech stock, and I was getting burned like you were on tech. Um, so I had it, and I had brought my stop up and locked in a lot of. Well, I brought it up to just over break even, right? And then
Right.
they announced earnings, and the thing went all the way down to the 50-day moving average, and then bounced the same day and went up like 20%. And so it went my break even was right around the 50-day. I stopped out by pennies, John, and then watched it fly up, 20% without me. And that psychologically that stung a bit. I'm still bitter about it, even though it's a
Let
model
me ask.
portfolio and there's no money there,
Right. Well,
right?
let me ask you a question. If you had been watching that in real time, would you have gotten back into that stock?
Uh, in real time, so I'm going to tell you No, I wouldn't have gotten back into it because it had so much movement on an intraday basis. And like I'll watch stocks that I like and see them dip down to support. Where there's stuff where I'll be watching, like gold, for instance.
Right.
I want it to bounce off the 21-day moving average again before I go in to feel that it has room to move up and it's tested support. And I'll use the 50-day when that's relevant for support as well for that. But I'd want to see it bounce before I get back in. But I'm not going to do a bounce on an intraday basis, right?
Right. Well, then that tells me you made the right decision on Goosehead. But
Yeah, and here's the
with
deal: is I
this,
made like $24 on it.
yeah, it just
Yeah, I didn't lose money on it. Yeah, no, it was the right choice. It was the right choice, obviously. Uh, and then when you look at, so that was the point where the stop uh, sort of prevented me from riding it up that day. But then I look at there's some other things that, well, Aflac, for example, another insurance stock that plummeted through my stop. I locked in like an 18% gain on that. It had been as high as like 24, but it's still going down and looks like it's
right.
going to go below the 50. And there, that stop, even though on that day it was a pretty close trigger and it went up a little bit afterwards, it's kept going down, and that stop saved me. Lockheed Martin, uh, after earnings went through the toilet, my stops really saved me from losing a lot there. So you're right. Your point there is that even when it stings and you get left behind every once in a while, it was still the right choice. One lesson I took from this earnings season is, you know, sometimes I'll bring the stop up to break even, but not at the same time really checking or keeping up to date with where support is. And what happened with like Goosehead, it was slowly increasing. So the 50-day moving average line was increasing slowly, and so was 21-day moving average. And it turned out that uh, when I set my protective stop to lock in break even, it was reasonably above the 50-day moving average, but the 50-day moving average caught up with that.
Right.
And what I'm going to be looking for now is, on a weekly basis when I look through the portfolio and decide, do I want to change any of my stops, that if I have a stop that ends up being just above a very obvious line of support, I'm going to bring that down a little bit just so I don't get stopped out by pennies, um, and stay in a couple positions that. What am I risking there? An extra fraction of a percent for the opportunity for an obvious line of support to hold, and I'm willing to give that up for that chance, right?
Right. Yeah. No, I agree. I think I do the same thing on stocks that I feel are have been performing well for me, where versus stocks that maybe I don't know. I bought it because it was moving in a leading direction or it was forming a technical pattern, but then it either didn't pan out, and now I have to hold it and decide whether I want to get rid of it or wait for it to do something. So
Mm,
you have to use a little bit of awareness on your stocks. But I think the key is just to uh, make sure you're making the right decisions, not uh, for based on the A.M.P.D strategy, not because of FOMO or something like that. So
that's fair. Let me ask you before we wrap up, um, going into an earnings period, and when a particular stock or particular company is going to report earnings, do you adjust your stops in anticipation of that? Like if you'd had a pretty tight stop for a while, would you give it a little bit more, uh, as long as you're not giving up more than you're willing to lose, right? Would you give it more room to handle earnings season, or you just kind of say, or do you tighten them up and say, listen, if it gaps down, I want to be out soon, and if it goes the other way, then it won't matter.
well, I did that yesterday. I had one stock that I felt was going to go up, so I tightened it up because I didn't want to lose anything in case the expectations were wrong, and it
Yeah.
actually went down, so that minimized my losses. And then another stock that I expected was going to be a little more volatile, so I loosened the stop on that a little bit, or rather, didn't tighten it at the end of the day. I left it bigger than because of the growth, and then stopped out of that stock as well. So
Yeah.
in the end, I think you just have to base your stops on whatever metrics you're using, whether it's resistance or momentum.
Not concerning yourself so much with whether it's going to move up or down based on earnings. It's more like a just hold fast to your what you want to do with that stock.
Yeah, I'd
And
rather, as Adam says, I'd rather make 10 solid bets, and even if I lose on 9 of them, the winning one should make up for all those other ones.
when you know earnings is coming up on a high profile company, and you know that there's both lots of institutional and retail investors on it, there's almost a feel of gambling if you were to buy a position in there right before earnings. And because I don't think anyone really knows how the market's going to react to an earning report, even if you knew what the earning report was in advance. If you had insider information, um, it's hard to know exactly how the market's going to respond to that. And so it feels like taking a wild bet to enter a position right before earnings. And that's, I think, antithetical to the A.M.P.D trading strategy, which is to make, we want to find leaders, and we want to see stocks that are behaving well. And we can't predict the market, but sometimes we find stocks that are behaving in a way that makes sense to us. And when there's volatile earning seasons like this one, then the stocks stop making sense.
I think that's also distracting from opportunities that are out there. For every stock that's reporting results today, there were 4 stocks or more that have reported earnings over the previous week, and all those are some of those are going to be leading stocks that are shaping up right or have gapped up on strong earnings and have good support and now consolidating in the low volume. And those are ones that you may want to take a look at investing in, instead of the ones that haven't reported their results yet and which feel like more of a gamble.
So I like what you said there. So there's, and I have a few on my watch list, stocks that have reported earnings. Some of them had nice big up days on earnings, and then if you keep them on the watch list and revisit them and see how they behave after that big up day, the big emotional volatile day, then I heard you say, that if the volume dries up a little bit and it consolidates and has a nice flag pattern, it'll develop this new support, and now you may have a nice entry point into a stock that's healthy and strong and just past earnings, so that volatility is less likely to happen in the very near future.
Yeah, I think that's the key strategy. That's the move to make during result season, instead of placing the bet on a stock you may think performs well
and
with good results, and
instead
then
of
being surprised by the market reaction.
Yeah, so instead of gambling on the volatility of earnings, you let earnings shake out the winners and losers, and then look at the winners that survive and find a good entry point.
Yep. There's 1,000 stocks a day you can look at. So why focus on the ones that are making the news that day for whatever reason?
All right, everybody, that's the podcast for today. I appreciate you listening through to the end. I hope you're having a good earnings season as well. I think we have some nice opportunities coming up. I'll be back next week with more. Until then, as always, keep your losses small and let your winners fly.
Too exciting for my taste.